Welcome back to the Deep Dive. We sift through the noise to bring you the signals that matter.
And today, we're jumping right into Petco. Their second quarter 2025 earnings call just wrapped on August 28th.
Yeah, and what really stood out wasn't just the numbers, but the market's reaction. Really positive.
Absolutely. And management's tone, too, very confident. It feels like they're serious about this profit-first turnaround.
Right. It signals a real shift. But, the question is always, is it translating into actual results or just, talk? Let's dig in.
Well, the after-hours share jump suggests investors are buying into it. It feels like more than just chasing growth for growth's sake now.
Okay, so let's look at those results then, because Q2 was, frankly, surprisingly strong on the profit side.
Yeah, significantly beat expectations there.
Get this. GAAP EPS came in at 5 cents. The consensus was actually a negative 1 cent. That's quite a turnaround.
Huge swing. And non-GAAP EPS, 8 cents. Consensus was only a penny. So yeah, blowing past expectations on profitability.
Now, revenue was pretty much in line, $1.489 billion. It was down slightly, about 2.3% year over year.
Which is interesting, right? Because the story here isn't the top line. It's that bottom line improvement. That's what's getting attention.
Exactly. And this is where it gets, impressive. Gross margin expanded by 120 basis points year over year, hit 39.3%.
Solid number.
And adjusted EBITDA, that surged. We're talking 36.4% year over year, reaching almost $114 million.
Wow.
Plus, they generated about $54 million in free cash flow. So decent cash coming in the door, too.
Right. So lower sales, but much, much better profitability and cash generation.
Yeah.
That really speaks volumes about their focus.
Okay, so how did they pull that off? That's the core question. What's behind this profit-first transformation they keep talking about?
Well, it's not magic, it's execution. They really emphasize delivering on promises to fix the economic model, the retail fundamentals.
So specific levers, that 120 basis point gross margin jump, for instance, where did that come from?
A lot of discipline around average unit cost AUC and average unit retail AUR. They've put tighter guardrails in place, really refined their pricing and promo strategies.
So smarter pricing, better cost management from suppliers.
Exactly. And importantly, they said minimal tariff impact hit them in Q2. So these underlying improvements really got a chance to show.
Okay, makes sense. But cost control wasn't just on the product side, was it? SG&A expenses, selling, general, and admin dropped quite a bit.
Yeah, down $36 million year over year. That leveraged over 150 basis points. That's significant savings.
Where did they find that? Is it sustainable?
A big chunk came from optimizing employee benefits. That often leads to more structural, lasting savings, plus more efficient store labor, better operations overall.
So not just cutting, but rethinking how they operate.
Precisely. And you see it in the operating profit, up $41 million year over year to $43 million. That shows these cost cuts are flowing through effectively. Feels like a leaner model taking shape.
And inventory, too. That's always a tough one for retailers. They managed to cut ending inventory by 9.5% year over year.
Right, but here's the kicker. They actually improve their in-stock levels for customers at the same time.
How do you do that? Less inventory, but better availability.
It points to much sharper merchandising, better forecasting, better supply chain work, being more surgical, as they put it, not just slashing across the board.
And that frees up cash, obviously.
Absolutely. Ties into their liquidity position, too. They ended the quarter with $190 million in cash, plus an undrawn revolver, giving them about $684 million in total liquidity. That's a healthy cushion.
Okay, so this operational cleanup is what they call phase 2. They're setting the stage for phase 3, which is supposed to be a return to profitable sales growth, maybe in 2026. What's the vision for that?
It's centered around this North Star project, basically reimagining the whole Petco experience, looking at their heritage, but also, what today's pet parents actually expect.
And they've got 4 pillars for that growth.
Yeah. An amazing store experience, scaling up services, differentiating their merchandise, and winning with omnichannel. It's pretty comprehensive.
And we're already seeing bits of that store experience push, right? They relaunched the Where the Pets Go tagline.
They did, yeah. Rolled out fully in August. Early signs are positive. Apparently good engagement on social media.
Are those in-store events helping too? Like the food tastings, meet the critters? They even had a Shark Week thing.
Seems like it.
Yeah.
They mentioned sequential increases in Net Promoter Score, NPS, and high marks for staff friendliness.
Yeah.
It's about making the store a destination, not just a transaction point.
And on the operational side, those planogram resets in dog and cat aisles, is that just about making things look neat?
It's more than that. It improves on-shelf availability, Helps with those in-stock levels we mentioned and makes store staff more productive. Saves time, saves money.
Efficiency gains.
Exactly. And they're planning more resets for other categories. They're also giving more space to the stuff that actually sells well, the higher productivity items.
And I saw they introduced human-focused products, pet-themed stuff under $20. That seems different for Petco.
It is, but it came directly from customer surveys. People wanted it. It's an easy add-on purchase, plays into that whole pet-parent identity thing. A small bet on differentiation.
While also continuing to prune stores, right? Closing some underperformers.
Yep. 25 net closures planned for this year, 10 done so far year to date, brings them down to 1,388 U.S. stores. Just optimizing the footprint.
Okay, let's talk omnichannel and loyalty. They admitted phase 2 was very store-focused. What's the plan for e-commerce now they have a new leader there?
They're starting with the basics, getting the fundamentals right online. Things like site speed, page load times, making appointment scheduling easier, improving repeat delivery.
Reducing friction, essentially.
Exactly, and making it profitable. Build the foundation first. Then, looking out to 2026, they're planning a loyalty program, relaunch more personalization, really focusing on retention using better customer segmentation.
Trying to get more value out of existing customers, maybe those who only use services or shop occasionally.
Precisely. Grow that share of wallet and lifetime value.
All right, let's shift to guidance. They actually raised their adjusted EBITDA outlook for the full year. Now $385 to $395 million.
Yeah, up from $375 to $390 million previously. That's a confident signal.
But net sales are still expected to be down low single digits for the year. How should we read that mix? Higher profit, lower sales?
It reinforces that profit-first story. Management's basically saying, we can make more money even if sales dip slightly because we're running the business better.
And for Q3 specifically?
They're guiding for net sales down low single digits again, but adjusted EBITDA between $92 and $94 million. That's up nearly 15% year over year at the midpoint.
But they did flag Q3 as having the toughest sales comparison of the year.
Crucial context, yeah. So hitting that Q3 EBITDA number will be a key test of their momentum.
And what about tariffs? They mentioned those becoming more meaningful in the back half, especially Q4. How do they handle that without just hiking prices?
That's the balancing act. They said pricing is a lever, but they want a consumer-first lens. So expect strategic pricing, maybe not across-the-board hikes.
Other levers, maybe. Sourcing. Different product mix.
Yeah, they mentioned sourcing, expanding higher margin areas like pharmacy, regrowing the supplies business. They have options beyond just price. And they still expect positive comp sales to return in 2026, seeing tariffs as a bump, not a roadblock.
Plus, they mentioned keeping some dry powder for investments or macro issues. Sounds prudent.
It does. Planning for potential volatility.
So, putting this all in context for investors, the market clearly liked this report. Why now? What's the bigger picture?
Well, the overall retail market's fairly firm, S&P's high, but the pet category itself is pretty value conscious right now. Services are the bright spot.
So Petco focusing on profit in a flat-ish industry makes sense.
Exactly. It's about optimizing what they have, not just chasing elusive growth. The market seems to be rewarding that operational discipline. But the big question remains.
Is this a real turning point or just a relief rally?
Right. Execution is everything from here. They need to keep hitting these milestones.
So if you're tracking this, what are the key things to watch in the near term? The catalysts.
Okay, first, hitting that Q3 EBITDA guidance despite the tough comp, that's critical. Second, watch the services metrics attachment rates, using their grooming and vet capacity better. That's their high margin engine.
Their moat, as they call it.
Their moat, yeah. Third, progress on vendor talks and those assortment resets. Can they sustain the gross margin gains? And fourth, listen for clues at the upcoming Goldman Sachs conference on September 4th.
Any other levers for margin expansion besides pricing?
Definitely sourcing, as we mentioned, expanding pharmacy, getting that supplies business growing again, and engaging those occasional shoppers or services-only customers, more effectively turning them into bigger spenders.
Got it. Okay, time for our not financial advice segment. Wild yet plausible trade ideas only. You go first.
All right, so Petco keeps calling services their moat. High margins, sticky customers, grooming, vet, pharmacy.
Right, the crown jewels almost.
So my wild idea, reverse spinoff. What if Petco formally announces a strategic review to carve out just the services business?
Spin off the services into like a separate company.
Exactly. Call it Petco Care or something. A publicly traded entity focused purely on pet health and wellness services.
Huh. Okay, audacious. What's the angle there? Why do that?
Two things. One, It could immediately re-rate the remaining retail business, make it look leaner, more cash generative, maybe shed that lower retail multiple.
Okay.
2, Petco Care itself could potentially trade at a much higher valuation. Think healthcare multiples, not retail multiples. It leverages their existing store footprint and customer base, but gets valued like a high-growth healthcare services provider.
Unlock hidden value by separating the parts. Interesting. Definitely fits the wild yet plausible bill.
It reframes the whole story.
So wrapping this up, Petco's Q2 really showed their profit-first turnaround strategy is gaining traction. Strong beats on EPS, adjusted EBITDA, impressive margin expansion.
Yeah, even with that modest sales dip, the focus on cost control, smarter merchandising, and growing services seems to be working, and they backed it up by raising the full-year EBITDA guidance.
They're laying the groundwork, they say, for getting back to profitable sales growth in 2026. But they do have those tariff headwinds to navigate in the meantime.
Absolutely.
And just a reminder, this is general market commentary. It is definitely not financial advice. Always do your own research. Talk to a professional.
Right. And here's something to think about. Petco's proving this profit focus works now. But looking ahead, how vulnerable are they? If tariffs hit harder than expected, or if the pet market stays flat or even softens, is that services moat really enough to guarantee a return to growth in 2026?
Or will they need something else, maybe that revamped omnichannel strategy, to really kickstart sustainable long-term expansion? It's a compelling turnaround story, for sure, but the next chapters aren't fully written yet.
Definitely want to keep watching closely.
Let us know what you think. Thanks for tuning in to The Deep Dive.